Imagine wanting to buy into the hottest US tech IPO. I mean, you have done all your research. You're absolutely ready to pull the trigger, but there's this massive catch.
Right, you live overseas.
Exactly. You live overseas. So by the time you finally get access to those shares through your, traditional international broker, the price has already doubled.
Oh yeah, you've completely missed the boat.
You missed it because of geography and legacy banking hours. But now imagine a completely different world, a world where you could buy that exact same share, fully backed, fully regulated, directly from your self-custodial crypto wallet.
Like right at the exact minute it lists on the exchange.
24/7, no borders, zero delays. And the crazy thing is, that is no longer a science fiction pitch.
No, it's really not. We are actually watching it happen in real time. And honestly, it is completely rewiring the underlying plumbing of global finance.
Which brings us to today. Welcome to this deep dive. We are looking at a massive stack of sources from April 2026 today.
Yeah, we've got a lot to get through. Market research reports, tokenomics data, company blogs, financial news.
Our mission today is exploring Ondo Finance. They're a platform that is spearheading what analysts are basically calling the institutionalization of the ledger.
Which is quite a phrase.
It is. We are going to unpack exactly how they are attempting to bridge the $480 trillion traditional finance world with decentralized finance.
Right.
And we'll analyze whether this so-called Wall Street 2.0 is the definitive future of markets, or, if it's hiding some serious structural flaws. Okay, let's unpack this.
Let's do it.
If we are going to understand how we arrive at a world of tokenized IPOs, we first have to look at the baseline of all markets.
Which is cash.
Cash, exactly. Why is the current version of crypto cash, like your traditional stablecoins, fundamentally broken for a serious institutional investor?
Well, the underlying issue with something like Tether or USDC isn't that they don't work for trading. I mean, they are incredibly useful for transferring value quickly across borders.
Right, they're super fast.
Yeah, but from an institutional perspective, holding them represents a massive, unacceptable opportunity cost. Think about how a corporate treasury or a major hedge fund operates.
They aren't just leaving that cash under a mattress.
Exactly. They don't just leave hundreds of millions of dollars sitting in a checking account doing nothing. They put that idle cash into short-term government bonds to earn a reliable, risk-free return.
Which you just can't do with a standard stablecoin.
Right. Traditional stablecoins don't generate any yield for the holder. So if an institution wants to play in the crypto space, they have historically had to accept basically 0% interest on their cash reserves.
So if traditional stablecoins are essentially dead weight for a corporate treasury, what exactly is Ondo replacing them with? Because reading through these reports, it's clear they aren't, trying to fight traditional finance.
No, not at all.
They're calling themselves a liquidity conduit.
Yeah, and what's fascinating here is how Ondo realized the ecosystem lacked high-quality, yield-bearing collateral. We are watching a structural shift from that highly speculative crypto era to a real institutional-grade era.
Because before this, you had to choose, right? Safety or yield.
Exactly. Before Ondo, if you wanted safety in crypto, you accepted zero yield. If you wanted yield, you had to lend your tokens to some anonymous, untested smart contract and just
pray you didn't get hacked.
Basically, yeah. Pray you didn't get hacked.
Yeah.
So Ondo stepped in and essentially wrapped the safest asset in the world, the US Treasury, into a token format that can be used natively on blockchains.
And that's their USDY product.
Right. They launched USDY, which is a stablecoin alternative backed by US Treasuries and bank deposits, and it's offering an APY between 4.2% and 4.8%.
And looking at the data, the adoption there is staggering. I mean, USDY already has over $1 billion in what crypto calls total value locked, or TVL.
Which means $1 billion of actual capital sitting in the protocol.
Wow. And they also have another product, OUSG, which is backed by BlackRock's BUIDL fund. That one targets institutions with a roughly 4.33% yield.
Yep, it's massive.
So if holding regular stablecoins is like keeping your money stuffed under a digital mattress, holding something like USDY is like having a high-yield savings account seamlessly wired directly into your crypto wallet.
That's a great way to put it.
But hold on, I have to play devil's advocate here for a second.
Go for it.
Isn't this just traditional finance with extra complicated blockchain steps? I mean, if I'm an institution, why not just pick up the phone and buy the treasury bill from a regular broker?
Because operational efficiency is the real product here. In traditional finance, if you want to move money out of a money market fund to settle a massive transaction, you are bound by all this legacy infrastructure.
You mean like the actual banking system?
Yeah. You are dealing with banking hours, holidays, clearinghouses, and, what they call T+1 or T+2 settlement times.
Meaning the trade happens today, but the actual money and assets don't officially change hands for another 1 or 2 business days?
Precisely. It involves batching transactions and manually reconciling all these different private databases. It's incredibly clunky.
Right.
But with an on-chain asset like OUSG, because the underlying BlackRock fund supports it, institutions can mint and redeem these tokens 24/7, 365 days a year.
So the settlement is just immediate.
Atomic and instant. For a massive institution managing real-time global cash flows, the ability to instantly collateralize or liquidate a treasury asset at, say, 2 a.m. on a Sunday
That's huge.
is a complete game changer.
Yeah.
That mechanical advantage is why Ondo currently commands roughly 80% of the tokenized U.S. Treasury market share.
Okay, that makes sense. Treasuries are essentially the reinforced concrete foundation of the financial system.
Right.
But nobody gets rich just staring at their foundation. I mean, traders want the skyscraper built on top where all the high-stakes action happens. They want equities.
Oh, absolutely.
Which seems to be the exact problem Ondo's next massive product is trying to solve.
Yeah, government bonds prove the legal and technical model works safely. But equities are what global retail investors are actually desperate to trade.
And the numbers for Ondo Global Markets, or OGM, really reflect that desperation. Within months of launching in late 2025, they shot up to over $500 million in TVL.
Capturing more than 50% of the tokenized stock market share.
Yeah. They are currently offering over 200 tokenized stocks and ETFs. We're talking Apple, NVIDIA, Tesla. But for you, the listener sitting at home, what is the actual mechanical difference between buying Tesla on E-Trade versus buying tokenized Tesla through Ondo?
If we connect this to the bigger picture, the difference is democratization of primary market liquidity.
What does that mean in practice?
Historically, if you are an investor in an emerging market, say in South America or Southeast Asia, getting access to a U.S. stock is a nightmare. It involves prohibitive international brokerage fees, awful currency conversion hurdles, and terrible execution times because you aren't trading directly on the primary exchange.
You're getting the leftovers, basically.
Yeah. Ondo is taking the actual security, holding it with a heavily regulated custodial broker-dealer in the U.S., and issuing a one-to-one backed token on-chain.
And they are putting those tokens exactly where the crypto users already are. I mean, in early 2026, they integrated with Solana, BNB Chain, and MetaMask.
Which is brilliant distribution.
Tens of millions of users can now hold traditional tech stocks right next to their Bitcoin and Ethereum in a self-custodial wallet. But, and here's where the concept starts to get crazy, the most wild detail in these sources is their Ondo Global Listing Initiative.
Oh, the BitGo IPO.
Yes.
They successfully brought the BitGo stock on-chain on the actual morning of its IPO.
Which is huge. Bringing an asset on-chain the moment it enters the public market effectively bridges the gap between Wall Street's opening bell and the global borderless blockchain environment.
Here's where it gets really interesting, though, because critics look at this tokenized stock model and claim it fractures market liquidity.
Right, that's the common fear.
Yeah, if you're splitting trading volume between the real-world NASDAQ, Solana, and Ethereum, doesn't the market get incredibly thin and inefficient?
You'd think so.
But Ondo defended their model by publishing data showing that 75% of their trades have spreads under 2 basis points. How do they actually maintain that tight spread without the on-chain prices completely decoupling from the real-world stock market?
It all comes down to their routing mechanism. They aren't just creating some synthetic derivative that hopes to track the price based on arbitrage traders doing the heavy lifting.
So it's not a simulation?
No, because Ondo Global Markets is deeply integrated with registered broker-dealers, the token routing is functionally tied to the primary exchange.
Okay.
When an order comes in on-chain, their infrastructure routes it to execute directly against the deep consolidated liquidity of the NASDAQ or the New York Stock Exchange. That mechanical link is how they keep the spread so incredibly tight.
Wow. So they've cracked the code on spot trading. But if you talk to any serious trader, spot trading is just child's play. Advanced markets run on leverage.
They definitely do.
They need derivatives. But how do you offer leverage on a blockchain without forcing traders to lock up all their cash? That seems to be the exact bottleneck that Ondo Perps was built to eliminate.
Exactly. The current landscape for crypto derivative platforms is plagued by terrible capital inefficiency. Ondo Perps is their newly announced platform for perpetual futures on U.S. equities and commodities.
And they're offering up to 20x leverage, right?
Yeah, up to 20x.
Yeah.
And to grasp why this is such a massive structural evolution, we have to look at the flaw it corrects, the double collateralization problem.
Can you break that down? What exactly is double collateralization in this context?
Let's say you are trading on a standard crypto perpetuals platform.
Yeah.
And you spot a great opportunity to short NVIDIA.
Okay.
To open that short position, the platform's smart contract requires you to deposit a stablecoin like USDC as collateral. But what if your portfolio is currently sitting in tokenized Apple stock?
Ah, I see where this is going.
Yeah. To make the trade, you would have to sell your Apple stock, incur the fees and taxes, convert it to stablecoins, and lock it up just to open your NVIDIA short.
Your capital is basically locked up twice over.
Precisely.
Oh.
You lose the Apple exposure you actually wanted to keep just to facilitate a completely unrelated trade.
So to put it in everyday terms, it's like being able to use the deed to your house to instantly day trade gold futures while still living in the house.
That is the perfect analogy.
With Ondo Perps, you can use tokenized securities like USDY or tokenized Tesla stock as collateral to open leverage positions on entirely different assets like NVIDIA or gold.
Exactly.
Yeah.
You earn the 4.8% yield on your USDY collateral while simultaneously expressing a leveraged directional view on gold or Microsoft.
That's incredibly capital efficient.
It is. Eliminating the friction of constantly moving capital between different isolated protocols makes the platform infinitely more attractive, especially for large-scale market makers who provide the liquidity.
Hold on, though. Leverage and derivatives are exactly where crypto usually blows up. I mean, this is the wild west of finance.
It has been, historically, yes.
Crypto smart contracts break when someone types a single wrong line of code. So if a major real-world event happens, say Apple issues a surprise dividend or NVIDIA does a 10-for-1 stock split overnight, how on earth do they accurately account for real-world corporate actions without the smart contracts failing and liquidating everybody?
That specific vulnerability is why Ondo realized they couldn't just launch this complex infrastructure on a general-purpose blockchain like Ethereum.
It's too unpredictable.
Right. Managing the sheer chaotic complexity of corporate actions, instant data feeds, and global regulations requires an entirely custom-built environment.
Which explains the launch of Ondo Chain. The sources describe it as a Layer 1 blockchain built specifically for real-world assets.
Yes, purpose-built.
And looking at the technical specifications, it operates completely differently from a typical crypto network. They use the Cosmos SDK to build it. For the listener, what does that actually mean?
The Cosmos SDK is essentially a highly modular toolkit. It allows developers to build a custom, independent blockchain from scratch, rather than renting space on a crowded network like Ethereum.
Okay, so they have their own highway instead of sharing one.
Exactly. And Ondo used this toolkit to design an architecture centered around compliance at the consensus layer. On a normal blockchain, like Bitcoin or Ethereum, anyone can spin up a validator node to secure the network as long as they have the hardware and the native tokens.
Right. It is inherently permissionless and pseudonymous.
But Ondo Chain uses permission validators, meaning the only entities legally allowed to validate transactions and process the blocks are regulated financial institutions.
We're talking Wall Street broker-dealers and massive asset managers.
Exactly. Furthermore, they utilize a mechanism called RWA-backed staking. Instead of an institution having to buy and hold a highly volatile speculative crypto token just to participate in securing the network, they stake actual tokenized bonds and treasuries.
Oh, wow. So they just use the assets they already have.
Right. It solves a massive balance sheet headache. Institutions can secure the network using assets they already want to hold.
But getting back to my nightmare scenario about the NVIDIA stock split, how does this custom chain actually prevent the derivatives market from imploding when real-world corporate actions happen?
The secret weapon of Ondo Chain is a feature called enshrined oracles.
Enshrined oracles, what does that do?
Well, usually blockchains are completely blind to the outside world. They have to rely on third-party oracle networks to fetch off-chain data and bring it on-chain.
Which takes time.
Yeah, it creates a delay, and it introduces a massive vector for manipulation or hacking. Ondo Chain directly integrates over 50 licensed data providers, including Bloomberg and Reuters, straight into the core architecture of the blockchain itself.
And they use zero-knowledge proofs to verify that data. For the listener, what does a zero-knowledge proof actually do in this context?
Think of it like a bouncer at a club checking your ID. They need to know you are over 21, but they don't actually need to know your exact home address or your social security number.
Right, they just need the verification, not the raw data.
Exactly. A zero-knowledge proof allows the blockchain to mathematically verify that the pricing data coming from Bloomberg is 100% authentic and untampered with.
Without having to expose or slow down the proprietary data feed itself.
Right. The system achieves an error rate under 0.05%. That instant, mathematically guaranteed data integration is how the smart contracts know the exact microsecond a stock split happens, allowing the derivative contracts to adjust flawlessly without liquidating users unfairly.
This intense focus on bulletproof compliance isn't just about the technology either. I mean, the regulatory strategy here is fascinating. In December 2025, the SEC officially closed its multi-year investigation into Ondo with 0 charges filed.
No enforcement action whatsoever, which is rare in this space.
Very rare. And shortly after, Ondo finalized the acquisition of Oasis Pro.
That acquisition cannot be overstated. Oasis Pro holds SEC-registered broker-dealer licenses, alternative trading system licenses, and transfer agent licenses.
So they essentially bought a fully licensed, legally compliant Wall Street trading venue and hardwired it directly into their blockchain stack.
That's exactly what they did.
Plus, they secured EU MiCA approval, which legally opens the door to 500 million European investors. And to fund the expansion of all this infrastructure, they launched a $250 million catalyst fund alongside Pantera Capital.
The broader strategy here is incredibly pragmatic. A significant portion of early Web3 projects spent their time trying to outrun global regulators or find loopholes around the SEC.
Which didn't end well for most of them.
No, it didn't. Ondo's entire foundational model is predicated on integrating deeply with the regulators. The closure of that SEC investigation without charges provides the exact legal clarity needed to aggressively scale their operations, particularly within the United States market.
I hear that, but I have to challenge the premise of Ondo Chain for a second. Wait, if the validators are just traditional Wall Street banks subject to FINRA regulations and the network is completely permissioned so only approved people can play, doesn't that defeat the entire decentralized, permissionless ethos of Web3? Are we just recreating Wall Street with new software?
That is the central, unresolvable tension of the entire tokenization movement.
Because it really just sounds like Wall Street 2.0.
Blockchain purists argue that yes, this is just traditional finance putting on a trendy Web3 mask. But from Ondo's perspective, true, massive institutional adoption moving tens of trillions of dollars of highly regulated global securities legally cannot happen on an anonymous, permissionless network.
Because you could have a sanctioned entity running a node.
Or a state-sponsored hacker. They are intentionally sacrificing ideological decentralization in exchange for operational reality and strict legal compliance.
Okay, so let me summarize where we are. The technology is genuinely groundbreaking, solving real capital inefficiencies. The regulatory moat is incredibly deep, with SEC clearances and major acquisitions. And they are actively managing billions of dollars in total value locked. Which makes this next part of the data incredibly confusing.
The token price.
Yeah. If they are winning on every front, why has the Ondo token price been struggling so brutally?
The disconnect between a protocol's fundamental success and its native token's market price is the great paradox of the current crypto landscape.
Let's look at the brutal tokenomics reality. In mid-2025, the token hit an all-time high of $2.14. But looking at these April 2026 charts, it's hovering between 20 and 27 cents.
It's a massive drop.
A huge contributor to this collapse was the unlock event that occurred on January 18th, 2026. Explain the mechanics of that, because the token unlock isn't just a magical price drop.
Right. When a project raises money, the venture capitalists and insiders who funded it get their tokens locked up in a smart contract for a set period of time.
To prevent them from dumping on early retail investors.
It's exactly. On January 18th, that lock expired for a massive tranche of tokens, almost 2 billion tokens, which represented about 57% of the circulating supply at the time, flooded the liquid market in a single day.
Over 50% in one day.
Yeah. When you increase the available supply of any asset by over 50% overnight, and early investors decide to take profits, intense downward price pressure is a mathematical certainty.
But institutional analysts in these reports don't seem panicked. They view this unlock as a painful but entirely necessary step to eventually decentralize the token's ownership away from those early venture capitalists.
It is a necessary evil.
However, supply dilution is only half the story. The sources highlight a massive value capture gap that I think is the real aha moment for understanding crypto economics.
Absolutely.
Ondo generates around $54 million in annualized fee revenue from managing all these treasuries and equities. But historically, the people holding the Ondo token received exactly 0% of that massive revenue. The token was purely a narrative asset for DAO governance.
And to understand why it was structured that way, you have to look at the legal fear paralyzing the industry.
The SEC.
Yep, the SEC's Howey test. For years, Web3 projects were terrified that if a token paid out a direct share of protocol revenue, like a dividend, the SEC would immediately classify it as an unregistered security and shut them down.
So they just gave it voting rights and nothing else?
Right. The industry created these governance tokens that allowed you to vote on software updates, but gave you no economic rights.
It's like owning a voting share in a wildly profitable tech startup that absolutely refuses to pay a dividend.
Yeah, the value is entirely speculative.
But Ondo is actively pivoting away from this, right? The Ondo DAO recently introduced a fee-sharing program to link token rewards directly to the platform management and minting fees.
This raises an important question regarding how token utility must evolve. The introduction of fee sharing is a massive precedent. Now that they have regulatory clarity from the SEC closing their investigation, they feel comfortable testing the legal waters of value accrual.
Because they have to if they want the token to survive.
If they want to reach the bullish price targets analysts are projecting for the 2030 period, they absolutely have to close that value capture gap. The token needs to have direct, undeniable economic utility based on the platform's actual cash flow.
But the lingering question for retail investors is whether this new fee-sharing model is enough to offset the massive supply dilution from those VC unlocks. Or are retail investors just providing exit liquidity for the early venture capitalists?
It is a highly valid concern, and it explains why the broader market is pricing the token so cautiously right now. But to understand the potential upside, you have to compare Ondo to its competitors.
Who else is doing this?
Look at a player like Securitize, which handles the infrastructure for BlackRock's BUIDL fund. Securitize is highly regulated, incredibly safe, but it has a $5 million minimum investment threshold.
Okay, so that is strictly built for institutional whales.
Exactly. On the completely opposite end of the spectrum, you have decentralized private credit protocols like Centrifuge or Maple Finance. They offer much higher yields, sometimes 9 to 12%, but you are lending to crypto market makers or emerging market businesses.
So the default risks are significantly higher.
Much higher. And the liquidity can dry up instantly.
So Ondo is strategically trying to play the Goldilocks role. They want to be accessible and frictionless like DeFi, but strictly backed by the safest government and corporate assets on Earth.
Right in the middle.
And reading the conclusions of these reports, analysts say the bullish 2030 estimates rely entirely on capturing a significant slice of the projected global RWA market, which is estimated to reach between $16 and $30 trillion by 2030.
If Ondo maintains its infrastructure dominance as that $30 trillion of legacy assets migrates on-chain, the fee generation will be staggering.
But they have to structure it right.
Right. The underlying tokenomics must be structured to ensure that massive value actually flows back to the token holders sustainably.
So, what does this all mean for you? Whether you are an institutional whale or a retail learner, the barrier between Wall Street and the blockchain is actively dissolving.
It really is.
Tokenization is shifting from a crypto niche to the default plumbing of global finance. The era of key+2 settlement delays and bankers' hours is dying, and instant 24/7 global liquidity is taking its place.
The shift from analog to digital asset movement is profound. But looking at the scale of what Ondo is building leaves us with a critical, lingering thought.
What's that?
If Ondo's vision succeeds, and every traditional asset, from tech stocks to treasury bonds to commodities, becomes a seamlessly integrated, cross-collateralized token traded 24/7 on a unified global ledger,
Yeah.
what happens during the next global financial panic? In our traditional clunky system, banking hours, settlement delays, and geographic borders act as natural circuit breakers that slow down the chaos.
That's true. They stop the bleeding temporarily.
But in a system with zero geographic friction and instant liquidity, does a market crash get easily contained, or does it spread at the speed of light? Something for you to ponder.